How do you trade the opening of a trading session? It doesn't matter if it's London or the New York one. You probably heard about the opening range strategy, and let me guess, you were told to mark the opening of the session, and then you simply trade a breakout. But is this really a consistent strategy? Does it bring consistent profits? Actually, no. Today I plan to share a different approach to trade the opening range. It involves finding liquidity zones where a lot of traders set their stop losses and fading the initial momentum. It's gonna be interesting. So, like, subscribe to the channel, and stick around for the full video. Right at the market open, let's say the New York time, markets usually experience volatile price action that arises from heavy buy and sell orders that come into the market. This heavy trading in the 5 minutes is the result of the profit or loss taking of the overnight holders, as well as new investors and traders. If the price has gapped up, some overnight traders will start selling their position for a profit. At the same time, some new traders might jump in to buy before the price goes higher. If price gaps down, on the other hand, some traders might panic and close their trades right at the open before it drops any lower. On the other side, some institutions might think this drop could be a good buying opportunity, and they will start buying large positions at a discounted price. You see how there is a complicated mass psychology unfolding at the open of the trading session. My advice is to wait during the first 5 minutes when market opens. It's better to watch the opening ranges to develop and allow the other traders to fight against each other until one side wins. Typically, you want to give the opening range at least 5 minutes. You can wait even longer, such as 15 minutes or 30 minutes, to identify the balance of power between the buyers and sellers. The longer the time frame, the less volatility you can expect. Then you need to develop a trade plan when a breakout occurs. Now, the opening range breakout tends to work best with mid to large cap stocks. I don't like trading this strategy with low volume stocks or penny stocks that have gapped up or down. And here's another tip to filter the best markets to trade. Ideally, the stock should trade within a range which is smaller than its average true range. There are various definitions about what the opening range means. I call it the gap between the low and the high price of the first minutes of trading. Here's an indicator which helps you to plot the opening range. It's a versatile one because it allows you to easily change the range period. Being a day trading and a scalping technique, we'll check the 5-minute opening range high and the 5-minute opening range low. But again, you can try different ranges from 5 minutes to 1 hour. With these settings, the indicator draws a channel after the first 5-minute candle of the New York session, one line at the candle's high and one line at the candle's low. A breakout of the opening range occurs when, after the first 5 minutes, the price crosses the highest or the lowest line. Either the price breaks out and starts on a new trend, or it reverses and the price dives back into the existing channel. Oftentimes, the opening range is the comfort zone of the day. Like I said before, the classic method is to trade the direction of the breakout. And it works sometimes, but it's not that consistent. Many times, you'll find that price breaks the range, and instead of continuing this momentum, will return inside the range, maybe breaking the other side too. This is a form of liquidity hunting. Liquidity hunting can be explained as the process of removing the weak positions out of the market. Smart money will trap retail traders into the market at poor trade locations and then move against their positions, stopping them out. A liquidity hunt is basically an event where the stop losses of buyers or sellers are taken out and the breakout traders are trapped in. I've talked about liquidity clearouts in this video if you want to know more about this process. But what you need to understand is that these events are most common around price structures where many traders will watch the same price level or place stop losses around the same price level. Do you think the opening range is a price structure that might be targeted by smart money? Of course it is. Smart money would want to see that range broken and enter their positions while liquidation is taking place and absorb opposite orders. That's why you lose money when you trade the opening range breakout, the classic way. Here's a better technique. You need to find pockets of liquidity around the opening range. Watch for swing lows or swing highs in the market structure, where the majority of condensed stop losses will sit and where breakout traders might initiate other positions. If price is breaking the opening range and then enters a potential liquidity zone, which could be targeted by smart money, you fade the breakout. You enter in the opposite direction. So when price returns to the opening range and liquidity was absorbed, you enter in the opposite direction of the breakout. Fading the opening range has some good logic behind it. Anyone who tried a breakout strategy will know how challenging it can be. Too many breakouts don't work out the way you expect them to. Many breakouts that start off strongly quickly fade and start to track back into a range. That's why fading the initial momentum has potential. The profits to be made from a fading strategy may not be huge, but nevertheless, it can be rewarding if you know how to do it. To summarize the trade plan, after you build your watch list, you monitor the shortlisted stocks in the first 5 minutes of the open. You identify their opening range and their price action. Is the price jumping up and down, or does it have a directional upwards or downwards movement? Is it high volume, or it's a quiet opening with less activity? The opening range must be significantly smaller than the stock's average true range. If you see the price is breaking the opening range, watch for immediate price levels where other retail traders may place their entries or stop losses. If price enters the potential liquidity area and returns to the opening range, you find the trade in the direction of the current momentum against the initial breakout. Regarding stops and take profits, I'm still trying to find the proper location. Obviously, a good level to place your stop would be above or below the most recent liquidity clearout, and 2 times the risk is a good level to target. But in some cases, if you don't want to hold a position overnight, you'll have to settle with less. Always remember that fading the breakout is a short-term strategy, so don't expect a home run while taking such trade. Here's Tesla on the 5-minute time frame. During the first trading day, we have a small breakout above resistance, and we also have a breakout above this small liquidity area. The breakout wasn't so powerful, but technically it checked our conditions. So we could have taken a short trade when the price was inside the channel. The next day, we didn't have a signal. The price broke the opening range and continued lower in the first part of the session and slowly recovered during the second part of the trading day. The third day offered the best signal. We have the opening range and the firm breakout above it. Price also broke above this liquidity area. Here's an important tip. As time passes, and if price cannot break areas with multiple highs, chances are the liquidity around those price levels will increase with time. This was a classic liquidation event where the stop losses of sellers are taken out and the breakout long traders are trapped in. When price returned inside the channel using this technique, a short trade against the initial breakout was the high probability move. Again, depending where you enter, you must have a positive risk-to-reward ratio. The stop loss goes above this high, but if the distance is too big and you don't get a proper reward for the risk being taken, you need to adjust the stop loss. We trade Netflix on the 5-minute time frame. During the first day, we have a breakout above the opening range resistance, but we don't have a liquidity clear out. But observe how fading the breakout proved to be a good opportunity, even without the liquidity clear out. Now in hindsight, I see this support level, which was broken, and now is acting as a resistance. And when the opening range was broken, the price found resistance at the previous support. The point is, you can come up with your own entries, even without the liquidity clear out. The second day offered us another trade. We have the opening range breakout, this time below support. We then have another breakout below this swing low, which is a clear liquidity area, possibly targeted by the smart money. And price indeed changed direction after the breakout and returned inside the channel, which was a good opportunity to enter a long position. The third day, another decent trade. Observe the breakout above the opening range and above this major liquidity area. After the liquidity clear out above the highs, the price reversed back inside the range structure relatively quickly. And here's another tip. Timing is key. It shouldn't take much time for the price to rotate back below the broken resistance, not necessarily inside the opening range, but below the liquidity area. In the best scenario, it happens within the next 5 to 10 candles. There aren't set rules for the entry. You could use price action patterns, candlesticks, and even indicators to enter after the liquidity clear out. But the price must at least touch the upper line of the opening range. I hope you see the logic behind this technique. 3 consecutive days, and not one single clear breakout in the initial direction. The liquidity clear-out condition will filter many trading opportunities. If you trade markets with low ATR and that have a somewhat smaller daily range, you won't find trade signals every day. Trades which are backed by liquidity clear-outs have the highest probabilities. If you want to be more active, you need to take into account other factors to find trades against the initial breakout. So, you'll still fade the opening range breakout, but you'll rely on price action or volume to find opportunities. In this chart, we found the opening range breakout, plus the liquidity clear-out, and the retracement back to the channel, the strongest signal to sell. The second day, we didn't have any trades, as price broke the opening range and continued downward. The third day, we have a downward breakout and a slow and steady uptrend for the rest of the day. No liquidity clear out, but the fading aspect worked. Fourth day, no signal. We had a breakout and a continuation move. The fifth day, we had the earnings release, a big gap up and a white 15-minute candle. My advice is to simply don't trade during these days, as the market can be quite unpredictable. The next day, we had a breakout and another reversal. And in the following day, the same scenario. Breakout, price found resistance, reversed inside the range, and continued its downwards momentum. So during this period, one valid signal with a liquidity clear-out confirmation, 4 fading days during which price reversed after the breakout, 2 breakout continuation days, and 1 range day during the earnings release. You can see why fading the opening range might be the better trade instead of trading the initial breakout. This technique was based on the New York Open, but the same principles apply if you trade Forex or crypto and you want to trade the London Open. If you found value and want a follow-up video, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.